this is PI Health with another video. It has been a long time in the making of it. The reason for that is that we are going to be discussing home trader. What is a home trader? Home trader used to be somewhat of an interesting word. It used to be, let's say, boiler room operation back in the 1970s and in the 1980s. So we're going to be discussing in several segments of it what you have to know to be a home trader. That's the important key to it, what you have to know to be a home trader. Number one here, we see what is said here is so goes the market, so goes the dollar. The dollar goes, so goes the market. That's usually being said, and it is absolutely correct. We are discussing here the Federal Reserve. The Federal Reserve has the ADRs, has different type of segments of the market and market indicators that they are using, for example, to raise lower interest rates, including credit score. They can issue just about any kind of a credit score. Right now, credit score is approximately about 600, 650. Can they raise it to 700? Absolutely correct. Can they raise it to 750? If they want to, absolutely correct. ADRs they can issue. They can issue any form or any format of the instruments, financial instruments, for example, bonds. Short term, long term, mid term, they can do whatever they want. It is a completely autonomous agency. This is the key word, autonomous agency. They don't need the Congress, they don't need anybody, they don't need the President of the United States. They are completely independent agency. Now, for the economic and econometrics model, they use a 32 category. I was very lucky because I was in New York City, and in New York City I went to the Fifth Avenue Library. They do have that particular economic model. That particular economic model is incredibly complicated. No, you cannot get all that information that goes into that particular model. Only the Federal Reserve has that type of input into the model of each economic indicators or categories that they are actually monitoring. You cannot have that. Okay, so this is part one. Now we go to part two, GDP, gross domestic product. Well, money times velocity equals gross national product, import and export equals GDP. Now, that's basically a very, very simple economic model. When we're talking about money times, we're talking about the M2. Seasonally adjusted M2. Seasonally adjusted M2, money times velocity, it's a very good basic of it. This is, don't forget, this is the second part already. Then we can go to the leading economic indicators. This is the basic book. This particular book of the leading economic indicators is very, very vital that you understand it. What is a leading economic indicators? The 90s, not the old ones, but the new ones. Especially pay attention to page 77 to it. Oops, that's okay. But especially on this particular page, it is accurate to about 73% of the leading economic indicators. What goes into the leading economic indicator? What is a leading economic indicator? As you can see, that book is quite quite old. Then we come to another economic indicating book. This is called Econometrics. This is also a textbook. This particular textbook, pay attention to page 399. It's a Ken Smith, category GNP, gross national product, economic model. It is a relatively simple, model. This particular model. Why the GNP? You can adjust it later on for import and export, and then you can come up with a GDP. It has only 11 categories of it, and this is readily available. These particular economic indicators. Do they have a larger model? Yes, they do. But this, for a whole model, this is relatively simple and it is, economically speaking, quite durable. So you can adjust it because it has an 11 element. Element and category and cells. You have to understand the difference between category, element, and cells. I'm not going to get into what's what. It is a good estimation of the economy. It is just an estimation which way the economy is heading. Are they going advance or are they going to decline? Basically, that is all it is. Now we're going to go to the third area, what is known as a cash market, stocks, bonds. You can have margin call on the stocks, bonds. Not just only the stocks, bonds, but you can also short position it. And you can also buy it on margin. You can sell it on margin. What is the short position? Well, short position is nothing more, nothing less. You sell something that is not yours. Now, how is it possible? You have to be very, very familiar with it in a stock market. You can short it, absolutely correct. Now, you basically have three areas of a short position in the cash market. One of them is called a specialist. The other one is called the institutional and the public. These are the basically three categories of it. They do short it indeed, and boy they do. So you have to understand what is a short. A specialist is one of the most astute investor on the market. They basically can do just about anything they want. The specialist actually is on a New York Stock Exchange and on the market exchange. Other markets, no. They have market makers, but they are not specialists. Specialist firm is actually trusted with a particular stock within the trading. In other words, let's say you have a Volkswagen, then the specialist is actually trusted with this smooth flow of the market of the particular stock. That's what a specialist is do, and that's all they do. And believe me, they have direct access to all information directly to the board of directors. If they don't, then it is a major problem. And trust me, they do. That's why they call them a specialist firm. A specialist firm is the top of the line firms. The public is usually goes opposite direction. If the public goes up, usually specialist goes down. So in other words, it goes in opposite direction, but they can go in the same direction, or they can go, because there's two, you can go up, down, opposite directions, one or the other, and they can stay the same. So you have to remember that, and there is a mathematical formula for that. In this particular book, you can use that mathematical formula, and you can set them up. Now, the cash market basically is nothing new. You have to understand what's a cash market. You have to understand different type of stocks, whether it's a preferred stocks, whether it's a cumulative preferred stock. Do they have a cumulative preferred stocks these days? You have to understand different classes, whether it's an A, B, C, what it represents within the firm of the corporate that is issuing. You have to understand what's a treasury stock. The treasury stock that is actually within the corporate structure that they are not issuing. Can they buy it back? Can they actually extend more stocks to the market, which dilutes the stock sometimes, or they think it is too high, the stock. They can actually dilute it and they sell it when they think that the stock is too high. They can raise it. They don't have to pay the dividends, but what they can do, they can withhold the dividends, and from the dividends they can actually buy back the stock, or if a stock is too high, they think it's too high, they can issue more stocks. But that comes from the corporate treasury. That basically comes from the corporate treasury. Now we're going to go to another segments of it. We're going to go to the option market. Well, what's an option market? An option market is an option to buy or sell. Now they do have a straddle, which is, you don't know which way it's going, but that's a separate issue. So you have two basically different type of options. You have the European option and you have the American option. The Black-Scholes model is a exceptionally good model. Back in the 1970s, the option market just exploded because of a Black-Scholes model. The Black-Scholes model is nothing more, nothing less, except on options and futures. This is an exceptionally good book for that. It's by John Hall. They do have, this is the first edition, they do have a second edition of this book. As you can see, this book is quite a bit used. So, the option market, you must understand it's a differential equation. Because it's a differential equation, the mathematics is quite high. It is not 2 and 2 equals 4. And because it's not, it's a graduate, advanced, undergraduate, elective course for business and economics. The use of mathematics, the level of mathematical sophistication is too high. It is high. The reason for that is that it's a differential equation. So, the Black-Scholes model is indeed, today you can, if you understand the Black-Scholes model, you don't have to calculate it because there are actually calculators that do calculate option price, OPMs. Option pricing model stands for OPM. So, they have different types. The Black-Scholes is for the European. Now, for the other option, which is the American option, they have what is known as a Monte Carlo method of calculating because it's continuous. That's the difference. There's a finite of the expiration on that. There is basically no expiration on the American, but on the European, the answer is yes. So one of them is continuous, the other one is expiration on it. So, what else we have here? What else you have to know? You have to understand the futures market. What's the futures market? Well, just like what it says, it's for the future. Okay? Now, it is incredibly important. Now, how does the futures market relate to the Feds or the option market? Guess what? Interest rate. Yes, folks, the interest rate. It is incredibly important. Why? Because on the futures market and on the option market, you have the interest rate. On the futures market, you can also calculate the futures yield or the current yield of the Federal Reserve interest rate set. For example, the T-bill versus the futures, which is, let's say, on a monthly basis, you can actually calculate it. It's called the yield curve on the future. If the yield curve on the future is actually lower than the yield curve on the Fed, what do? Well, you guessed it, you buy it. If the yield curve on the future is higher than the Federal Reserve T-bill, you sell it. Some individuals are not doing the T-bill, they are doing actually CD rate, short-term CD rate, because it is actually very, very stable and they are limiting their trade. So it depends upon your taste of trade or your vulnerability within the portfolio, what you want to do. Now, it's also, there is one other model, it's called cost to carry, or the yield curve comparison, which I said the cost to carry model. For example, you have that is no yield on them. For example, on a gold, there is no yield on it. Now, can you use the option and futures? Absolutely correct. It's the black model. The black model is usually that it's options on futures, and yes, it is in this book, Cost to Carry Model. As I said, this is the first edition. You can use the first or second edition. I've seen the second edition. I'm used to the first edition, that's why I have it, and this is actually from the way back, and it still holds true today. So, what else we're talking about here? This is once you put it together, each particular one has an economic indicators. It will, if you're using more than 10 economic indicators, let's say if you are using 11, it's even better. But if you are using more than 11 economic indicators, then that means that you're using too much. Trust me on that one. So, what are the indicators? Well, I already gave you one. Goes the opposite direction, short position, specialist and public, or institutional or public. That's one major indicator. The other major indicator is the Black-Scholes model on the European option market. Then I gave you another one indicator here, which is an indicator which is known as a black model on options on futures. And I gave you another indicator. I gave you another indicator on the yield curve. If the yield curve, as I said, is below or above, if it's above, you sell. If it's below, you buy. The treasury, you can use the treasury or you can use a CD. I personally use the CD because it was less volatile than the T-bill. That's why. So you can balance it out on the volatility. Now we're going to get to the volatility a little bit. Putting it together a little bit. Here it is. This particular chart. On the volatility, as you can see, this particular volatility is, I have the volatility formula right up here. Now, what I did is, this is the cash index. The cash index comes from the volatility, and I have it broken down on the calculation of the volatility index. The reason that I follow this particular format is that I was able to see the change that it takes place on the volatility. This is actually the volatility that takes place on the particular index. This was actually done on the weekly basis, which I calculated my own, and I was able to see the exact changes. This is vitally important because the Black-Scholes model or the black model does have the volatility. So you cannot do without this. Can you actually press the button and get the volatility? Yes, you can. But here you can actually see the change of occurrences on that. Now, this is actually thinking with the model. The model is very important to think with. The reason for that you are eliminating your personal feelings. It is, you want to eliminate it as much as possible. What is your feeling in the market? Because trust me, the market is going to take your money. They're going to have no wits about it. It is a feelingless entity, the market. They have no emotions. So you have to think without emotion. Can you do it? If you can, these are what you have to know. And this is what you have to, it's a relatively simple models. And yes, you can get a calculator that calculates it for you. It is just that simple. It is not complicated. Now, putting it together a little bit, what you can do after that is you can set up an investment company. On the investment company, what you can do is you can actually set up a specialized portfolio. And this particular specialized portfolio is very, very important. So that you actually understand the complete structure of trading and involvement within the trading. These are not fancy words. These what you have to know. Because if you don't start it. On the option market, I have seen a resurrection. Back in the 1980s, it's called Financial Journal Analyst. And I've seen a resurrection of that particular model where they took geometric models and they put them into the bar system. Well, those days, the geometric model in the Financial Journal Analyst were actually 52% accurate. But this is, I'm going back to the late 80s. So if you want to look up the Financial Journal analyst, yes, you can, and you can actually read up on it completely on that. I wouldn't use it at all. Once you put this together, you actually can predict the outcome approximately about 70% accurately, approximately, which way the market is hitting and which way the market has a tendency to creep either up or down. Don't forget, you cannot get the information as the Federal Reserve does. No, it is not possible. But you can get some very nice information on the economy. You can get some very nice information on the cash market. You can get some very nice information on the option market because it's there. The strike price is there. The cash market price is there. And closer the strike price to the cash price, the more accurate you are. Matter of fact, I only did 5 points differences between the cash market and the strike price in the money. And then you can actually calculate a put call parity, which is a separate issue. The put call parity, yes, you can. On a put call parity, you will find the balance between the puts and the calls. Now, this is actually thinking with the model without your emotion. If you cannot do it, don't do it. Now we're going to be thinking of emotion. Let's look at it for a second. Thinking with emotion. All right, here it is. Thinking with emotion. Misinformation, USA, entitlement, vote, cancel culture, pressure groups, interest group. Now this is a very interesting one. Right here. This is contribution to the household income. Household income 50-50 for a man and a woman. Or is it 65 and 35? Autonomous agencies. What are the autonomous agencies? You have to understand what's the autonomous agency. This is one of them, right here, the Federal Reserve. It's one of the biggest and most influential autonomous agency there are. Then this particular triangle right here. This was actually came up with a Chinese economist who came up with this. Now each particular segment of this particular triangle was equally set. Not on this one, but you get the idea. You have the social score up here, which is an ideology. You have the politics of it right in here. Then you have the market asset. So what I did is I actually placed some indicators in here. The credit score, of course, this comes in here. Now, let's look at market asset. Asset minus liability equals capital. This is a very simple accounting model of what is a capital. But if you have too much pressure on the liability end of it from the asset, the capital is going to suffer. It has to suffer. It cannot sustain. And that's exactly what's happening throughout the world right now. It cannot, because of all this information and all this pressure. It cannot sustain itself. So when we add it into the market and the asset, money times velocity plus export minus import GDP, you can actually see how much pressure is actually being built on the M2. The reason for that, all this just siphons it out. We have another number here, 30%. 30%, what does it mean? 30% means that if the political and ideological pressure is more than 30%, you will have complete stagnation in the economy. That's why they have a Keynesian economic system. In a Keynesian economic system, what you have is a built-in social structure. Unemployment insurance, etc. I don't want to name a whole bunch of them. I just name one. Now what we have here? Now we have the labor. This is very interesting also. What is the labor? Unskilled labor, semi-skilled labor, and skilled labor. What are these numbers? That means that the unskilled labor spends 45% energy on the job. It is the least efficient in the market. The semi-skilled, 55%. Skilled, 65%. But okay, energy on the job. Okay, so where is the rest of them? Especially if you go into, let's say, in Jacksonville, the tax collector's office. And what I do is twice a year, 3 times a year, I go there and I just sit down and do my business. I don't make an appointment. It takes approximately about sometimes 3 to 4 hours sitting there. And I'm just watching the individuals and how hard some of these individuals work on a tax collector's office. It is amazing the number of people that they are actually serving. Just go into any one of them. You know, it's very simple. All you have to do is just go there. And yet, you're absolutely correct. This is the amount of energy that they spend on the job. It is mind-boggling. So the most and the least efficient is unskilled. And that's why the wages is somewhat very, very low. The semi-skilled, the wages are much higher, and on the skilled, of course, if you're a brain surgeon, yeah, you might have $600-700 an hour. But don't forget, even if you're a general surgeon, it takes approximately about 15 years before you can actually put your plaque out there that it says, I'm a general surgeon. 16 years of study. Just to be a cardiologist, 4, 3, and 3, and 3. 4 years bachelor in science, let's say, 3 years medical school, 3 years internship, and then another 3 years. Whoa! And we are wondering why they are making $300-400 an hour? That's why. So, skilled labor is the most efficient. But there is also a ratio between skilled labor, semi-skilled, and unskilled. There's also a ratio which I will not get into, which is an economic issue. So this is the actual influence your emotions. If this influences your emotions, you have no business being a home trader. Absolutely none. Can you make some nice money on this? Absolutely. But you must understand first part, second part, third, fourth, and fifth part. Without it, you will not succeed. This is a must. Thank you very much for listening. Have yourself a wonderful day.